how to set your risk management on MT4 or MT5. How to set your risk management on MT4. Of course, this will permit you to trade anything on MT4, be it CFDs, crypto, commodities, metals, stocks, currency, name them. Before we had this class, our previous class, day 8, we were discussing how to set your risk management futures trading on MEXC exchange. It was an interesting topic, and we saw how we manipulated the MEXC platform, the leverage, and also the quantity using the take profit and the predetermined stop loss to also decide how much we are going to lose or how much we are going to gain potentially if the trade goes to our favor or against us. It is nothing different from what we have on the MT5 or MT4, only that the platform varies and then the way it's executed also varies. If you remember one of our classes where we were discussing how to open a trade, you can also remember that we took this particular trade on AUD NZD on MT5, and we showed you how to open a trade. We set our trade entry at this level. We set our stop loss under this particular low, which was here. And as we can see, the price was supposed to go all the way top this place here, our take profit, but it didn't go there. It rather came backwards, further came backward, took out our stop loss at this level. This level coincidentally is an order block level. This red candle, we are currently on H4 time frame. And this order block candle is like a springboard, which we have to learn from. Perhaps if we can take our trade after the market or the price have reacted to the order block. Then you can see what happened here. It reacted nicely and pushed up to the top side. If you click here where you have our SL being taken and drag it upwards, you'd have about 31 pips. But if you drag it to the entry, you have about 53 pips. So we were saying, we were of the opinion that the stop loss should be around 50 pips from the entry. So in terms of that risk management parameters, we are very, very correct. In terms of the structure of the market where we entered from, a more better entry would have been after a pullback, then a bullish engulfing before our entry. So which we are currently at that position right now, where we would have made the best entry. All right. So we are not still talking about analysis, so I will not go deep into analyzing why the trade did not play or what can we do better next time if we have the opportunity. But what I will say concerning risk management as far as this trade is concerned is that the account balance started from $3,000, and after this trade hit the stop loss, the account balance dropped to 2,990. So you can see that if we take a calculator, for instance, from our calculator, you have 1% times 3,000 would give us $30. So it means what is taken from this account is around $90, which is 3%. So in terms of risk management, I would say it's very good for us to risk 1% of our account for each particular trade. Sometimes we can even risk 2% of our account for a particular trade. Why some traders can decide to take 3% of the account, it all depends on you, the owner of the money, the investor. How much do you want to risk for each particular trade? How much do you want to risk for the entire account? In this $3,000 in total, if all your positions are not going on well, how much totally would you be willing to risk from the $3,000? It's a very important question you have to ask yourself from the very beginning, even before you deposit the $3,000. In my advice, I'll say the highest risk you should take when you are going in to deposit your account, your funds in any of the accounts, is to decide to risk half of that money in total. Meaning that even if all your trade did not go to take profits, once you lose half of the account, stop trading, withdraw your remaining balance. So this decision have to be at the front of your mind before you deposit. That it is possible you could lose half of the capital, and it's allowed. And when that happens, you are going to initiate a withdrawal of the remaining half. This is my personal recommendation. Because if you keep your risk lower than half, or even lower and lower and lower, very small, tiny risks, always remember that it also impacts the profits you would potentially make. The market responds to risk. Higher the risk, higher the potential profits. So let me give you an example of a case study which we're about to experiment in the month of January for 2025. Let's say you have an account of $100. Yes. And let's say we are going to risk 35%. We are going to risk 35% on a single trade in 1 week. We are going to risk 35% on a single trade in 1 week. We will not take 2 trades, we will not take 3, we will not take 4 or 5. We'll take 1 trade. And we're going to hold it for the entire week. For 35% risk. That means if this trade goes bad, we are losing 35% of $100, which is $35. The next trade, we should only be risking 15% of the account. And if we lose that, we should withdraw the balance, because that will be 50% gone from the $100. We failed. And it's okay to fail. You go back to the drawing board, you learn from the failure, you check again, you start all over again, you take another risk. But please, honor the process of withdrawing when you fail. Withdraw your capital. It's a process. Withdraw it. Let there be a withdrawal initiated. After you withdraw, you look at the entire process again. You learn from the mistake, do more analysis in terms of money management, risk management, trade setup, etc. Then you engage again, or maybe calculation again of risk. But this is a case scenario where we are risking 35%, which is $35 from $100. And let's say the trade went in our favor, we win. So we are going to honor 1:3 risk reward. That means if the trade goes in our favor very well, we should make ×3 of $35. That will give us a profit of ×3 of this will be 105, if I'm correct. 105. So if the trade goes well, we make 105 profits. If the trade goes bad, we lose $35. So let's say the trade goes well, because we look at the other scenario and we look at what we do if the trade goes bad. Now, if the trade goes well, our total becomes 205. That's our new total. With 205, we are going to repeat the same scenario. We are going to risk 35%. If we risk 35% of 205, 35% times 205 is giving us 71.75. It means risking 35% will be risking $71. 71.75, actually. We can call it $72. If we lose this amount, if we take it away from the total, we will still have $133 if we lose our second trade. From $133, we can still decide to risk 35% for another trade. If we lose it, we can still decide to risk 35% on another trade. If we lose it, our balance will be around $50. We go home, we pack it, we withdraw. But if we do not lose it, it's going to take us further 1:3 always. It's going to give us 3 times 72. It's going to give us 3 times 72 if we win this trade, 1:3. So we have 72 times 3, which gives us $261 profits if we win. In a case where we win, we get 216. 216 is the profit that we make from this trade. When we add it to the capital we already have, it will give us a new balance. 216 plus 205. 421. So in the third stage, we are now at $421. Here, if we risk, remember this is in another week, one single trade, 1:3, a whole 1 week. In this stage where we have 421, if we decide to reduce our risk to 30%, that will give us something like 30% times 421. We are going to risk $126.3. If we lose, we are down to, let me write the risks first of all. If we risk 30%, which is $126. If we lose, we will be down to $294, which is higher than our second stage, but permits us to risk another 30% or 35%. I think 35%. And if we lose that one, it brings us higher than the first level, where we can still risk another 35%. If we lose one more step, 15%. If we lose, we'll withdraw our $50 and go back. And remember, each trade is executed in a week. So if you lose for this week, next week is an entire different market. So there's a high chance for you to reorganize yourself and get a better position. If you keep losing 1, 2, 3, it means something is wrong. You have to check what is wrong. Either the strategy, or the pair, or the market, or the analysis, or the setup. Something is wrong somewhere. You shouldn't just be losing back to back to back to back. But however, you can get to stage 3, where we are now, 421, and begin to lose, and lose back to stage 1 and back to the village, where you withdraw half of your capital, $50, and walk home. Second scenario, let's say we win 1:3. 1:3 of $126 is multiplying 126 by 3, giving us 378. 378, when you add this profit to the capital you have, 421, that will be giving us a total balance of 799. That means we would have risked more than 30%. That's the implication here. Because we are always supposed to double the capital at every stage. We would have risked more than that amount. So sorry, let's redo this calculation. This stage is supposed to be slightly above 799. It's supposed to be around 800. So let's just tweak a little bit and add one here. So we reached at 31%. I wanted us to have a situation whereby as we grow per week, we are reducing our risk. Because the capital is growing, we need to be reducing the risk. Higher capital require lesser risks, while lesser capital require a higher risk. That is the only way you can really make good money in this market if you know what you are doing. So you have, we are risking 31%. So that brings, let's say now, 31% times 421. That gives us 130 instead of 126. So here what we are risking now is 130. And if we lose this 130, we are still very good because we are getting something higher than the second stage, and we'll go back to risk 35 now to be able to bring us back again to 421. So here when we risk 130, let's say the risk was a good risk, we got a good run for it. So it will be 130 times 3. That will be giving us 130 times 3, 1:3, of course. That was giving us 390 instead of 378. So when we add 390 plus 421 plus 421, that'll be giving us 811. That's much better. That is according to our plan. So here will be 390. So the next stage, which will be our first, second, third, our fourth stage, we are now at a balance of 811. With 811, let's say this time around we are safe to risk 30% of the capital for that following week. And let's say it doesn't go well. Let's say we lose the account. We lose the account. So I know we lose the account. I mean we lose the trade. For that week, we lose the trade. When we lose the trade, what is 30%? 811 times 811 times 30%. No. 30% times 811. That's 243. If we lose that trade, we lose 243. If we take away, let me write that down first before we talk about taking away. $243. If we take away that 243 loss, if we take it out from the capital 811, what we'll be having is 567, which is higher than our previous balance. So we are still good. We are still good. Can you see that we are going somewhere? Even when we fail, we are failing forward. Please, if you are here with me, you are enjoying this risk management, and you are learning something, please write FF, fail forward. Even when we lose a trade, we fail forward. If we lose again, it means that something is not all right. So we have to push more. If we keep losing 5 consecutive times, it means there's a serious problem. We have to stop trading. Because at this stage, we are at stage 4, right? Stage 1 was $100. stage 2, 205, stage 3, 421, stage 4, 811. So traders usually do not do this calculation before they start trading on their capital. And this is why they get frustrated. If you do this calculation and you begin to fail, even your failure is part of your calculation. Because in this calculation, we have to check what is the worst that will happen to the trade. It's SL, loss. And when it happens, what do we do? It's calculated as part of the plan. If we don't have SL, what do we have? We have take profits. If we have take profit, what do we do? It's part of the plan. So he who failed to plan has already planned to fail. And when the failure comes, when you do not plan, it's very, very catastrophic, very, very painful, very, very disastrous, and it makes you want to give up. But if you plan with the failure in mind that, okay, this might happen, that might happen, and you don't see it as failure, you see it as part of the journey. It might cause a slight delay, but then it's still part of your plan. It doesn't mean you are not going to get to where you are going. It just tells you that something is wrong. You need to check something. So you go back to drawing board, check, 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 check. You come back again and you fire again with double cylinders. You cross and maneuver that obstacle and progress. And that even makes you more experienced person than somebody who has never ever failed in their journey to success, from $100 all the way to $10,000, or from $100 all the way to $100,000 thereabout. So we are here at stage 4, and our account balance is 811, and we risk 243, which is 30% of 811. And let's say the trade goes well. So if the trade goes well, what happens is that we're going to make 10 times 3. That's the meaning of 1 to 3 RR, risk reward. If it goes bad, you lose 243. If it goes well, we win times 3 of this risk. So what will be times 3? So 243. Now let's go to calculator again. 243 times, what did I use divided by? Can you imagine? 243 times 3. That gives us 729. 729 is the new profits we make if this trade goes well. If we add this profit to our capital, that will give us a new balance plus the capital, 811. Our new balance is 1,540. Where do I write this one now? 1,540. Here again, 8 plus 8 is 16. We have a deficit. We are not supposed to get 1,540. We needed something higher than this. So it means we have to go back a little bit. We have to go back a little bit. We need to risk 31% for us to be able to get double of 800, which is 1,600. And if we are risking 31%, we'll go back here and say 31% times 811, 5251. Yes. So this will be the exact risk. We are risking 251. And when we're risking 251, we are targeting times 3 of it. If it goes well, multiply this by 3. It's giving us a new profits, if it goes well, 7 54. If we add it to our capital, the total balance will now be, bring 811 here. This is crazy, oh. Still not giving us, oh. Then how come did we get this one to double? Wow. I will get this right, oh. I'm telling you, not getting it right is a problem. So we have to make sure we get it right. Not getting it right is a problem. Let me make it 33%. No, 32. Because we just have some very small fraction left. 32%. That keeps us at 32% times 811. We are risking 259 times 3, 778 plus 811. Still not okay. So we go back again and risk 33%. If we are risking 33% here, that will be 33% times 811, 267 times 3, if it goes well, 802. This is correct now. 267 is the right number. So we are supposed to risk 267. Then the reward will be 802. Yep. Then that will be stage 5. If we add this together, that will give us 802 plus 811, 16. 1613 dollars. We're risking 33% again. Let me be a little bit fast now, because that is not all about risk management. This is first of all the calculation. 33% times 1613. No, I didn't do it well, sorry. 33% times 1613. So we are risking 532. Multiply that by 3 if it goes well. One six one six. I think we're okay. Yeah, we are okay. Good. So the correct number is, the risk is 1,596. And if it goes well, the reward will be times 3. Okay, this is 532. Sorry. The risk is 532. That's what we are risking. Then the reward is 1,596, 1:3. Then if we add that to balance, our new balance will be plus 1613. 1613. Our new balance is 3,209. 3,209. We risk 33%. That will be 33%. 33%. 3,209. That will be, we are risking 1,058. If it goes well, times 3, we are making 317. 317. So if it goes, we are risking 1,058. If it goes well, we are making 3,176. If we add it up, our new balance will be there's no space to write this thing again. Our new balance will be plus 3,209. 6,385. The process of you calculating all this, it changes your mindset and expands you to become something. If this is boring for you, it means you have a very low mindset about finances and you need to follow the discipline of numbers. Until numbers don't get boring, you follow it rigorously and religiously, get them done. Then you jump into the market, you are disciplined because you follow the way it is. So why that is going on is important that you note that you are becoming something by following these numbers, and you are becoming a professional by religiously abiding by the numbers, what is happening there. It is very, very important. Very, very important that we state this clearly. Okay. Still here, please. 20 minutes. 20 minutes, 8 o'clock. All right. Okay. Where are we? This is the capital, and we are risking 33%. 33% times 6,385, which is 2,107 risk. If it goes well, times 3, we have a profit of 2,3. So we are risking 33%, and that risk is 2,107. And if it goes well, we have 6,321 profits. So our new balance will become doubled plus 6,385. That gives us 12,706. 12,706. And we are risking, let's bring the risk down to 31. And this will be stage 1, stage 2, stage 3, week 4, week 5, week 6, week 7, week 8. On the 8th week of this exercise, we are risking 31% of our capital, 12,706. And that would be 31% times 12,706, which will give us equal to, I'm correct, 3,938 is our risk. Multiply that risk by 3 if the trade goes well, 1:3. It gives us a profit of 11,816, which is very okay. So we add that to the balance. Our risk was 3,938. Then our profit was 11,816. If we add that together to give us plus 12,706. No, sorry, I made a mistake here. That'll be 11,816 plus 12,706. 24,522. 24,522. That's week 9. Let's risk 31%. And that will be 31% times 24,522, giving us 7,601 risk. Multiply by 3 if trade goes well. That gives us a profit of 22. So we have 7,601. 7,601. Multiply by 3 if the trade goes well, that will be 22,805. That will give us a new balance of plus 24. This balance is not good. We're supposed to have a double of this, which is around 24, 24, 28. This balance is not good. So it meant our risk is supposed to go higher. I think I'm understanding something here, that anytime we reduce the risk, we have to always still increase the risk again. So we reduce the risk too much from 33. We did 33 here. We're supposed to do 32 before we do 31. So we have to reduce it arithmetically, because this is not balancing. If we add this to this, we will not get double of 24. And the rule is for us to get double. So I'm going to go a step backward. Like I'm going to go a step backward for real. I'm going to go a step backward for real. I'm going to risk 32 and see. I'm going to risk 32. Increase the risk to 32. If we increase the risk to 32, that will be 32%. Yep. Multiply by 24,522. That would give us 7,847. times 3 will give us 23,500. This is better. 23,540, 24,522 will give us double. It's good. So we're using 32. So that would be 7,847, and that will be 23,541. Then we can now have plus. New balance will become 24,522. New balance will become 40,030. Our new balance will be 48, sorry. 063. This looks like week 10. Week 10? Yeah, I think week 10. Week 1, week 2, week 3, week 4, week 5, week 6, week 7, week 8, week 9, week 10. In the 10th week, we already have approximately $50,000. And then we take the same risk. It's the same thing, the same practice, the same thing you do to $10, the same thing you do to $100, the same thing you eventually do to $50,000. The same thing. So let's quickly wrap up, because this is not the main point. This is just the calculation part, the theoretical part, telling us the numbers, then to implement the number, and then be in the field where the metal meets the meat. That is where the whole thing's happening. Okay, let's go back now to say, okay, if we are here now, we are risking, well, let's do 32%. Let's do that 2% risk and see. 24 is 48. We just have 63 here. Do you think that 2% will do? Let's check. 32% times 48,063. No. 48,063. This will be risk of 15,380 multiplied by 3. 46,1 is not enough. So we have to increase that risk to 33% times 48,063. Risk of 15,860 times 3 gives us 47,582. It's not still enough, because we need a double of this, 48. So we go back again to risk 35. Let's reach 34. 34 times 48,063. 16,341 risk multiplied by 3 if the trade goes well. 49. This is very, very good. So we are risking 34. That's the point. We are risking 34. 34% risk. That's a risk of 16,341 at every point. Remember, if we lose, we are losing 16,341. It's going to take us back, but it's even going to be higher than the previous balance. If you remove 16,341 from 48, we're around 30 something. We are not back to the former step. We are like in purgatory. We didn't go to hell. It didn't take us away. So we still take similar risk before it brings us a little bit lower than this. So it gives us more opportunity to recover. That's the point. Anytime we lose any of this step, it gives us more opportunity to recover, because we maintain the same risk management. Yeah. So if we go further now with this, we are getting a profit of 49,024. If we add this up, that's week 11. Adding this up will give us 48,063. 97. $97,000. We have to stop here. That is week 10, week 11. Week 11. But let's go a bit further. Let's go a bit further and one for the road. 97,087. Let's risk lower this time around. Let's risk 20%. Let's risk 30%. We're not scared of this market. Don't be scared of the market, guys. Let's risk 30% this time around. That would be giving us 30% times 97,063. But the point is that if you lose 30%, you are not going down to 48. If you lose 30%, you have only lost $29,000. It's going to take you to something higher than 48, in between this and this. That's where you are landing. Because if you remove 29 from 97, that would be 50, 60, 70, 80, or 60, 70, 80, 90. It's around 60 something thousand dollars. That's where you drop at. So it still allows you to take the same risks and come back up again. Higher than this. In fact, if you lose any stage and you take the same risk, it's going to take you ahead of where you lost from. Because you are already used to that profit. You are already used to that profit. You have done that profit before. So you coming back again is going to take you higher than it. That profit is not staged to your account balance. That's what I mean. So if you risk this, you are risking 29,118. If it goes well, 1:3, you are going upward to a profit of 873. You see what I'm saying right now? So let's say you are risking 29, 3, 5, 6. Then if it goes well, you are making 87, 3, 5, 6. And then that gives you total of balance. Your balance at this 11th stage will be plus 97,887. 185,243. 185,243 is your balance. So there is something I learned from this movement, from 1 to where we are, week 11, in 11 weeks. If we maintain 35% risk in all the trade, in our 10th week, we would have crossed $100,000 because we were reducing the risk from 35 to 31, 33, 33, 33, 30, 33, 31, 32, 34, 30. So if we had maintained 35, 35, 35, 35, when we get to week 10, our balance will be $100,000 in 10 weeks. In 10 weeks. So I like you to maintain 35%, or let's say, 35% is okay. Or if we go to 34%, maybe this will give us a better figure. Let me see. 34%. If we go to 34%, let's say 34%, 34% times 100. That gives us $34 times 3. 102. Yeah. We can stay on 34% all through the maths. We can stay on 34% all through the maths. It's going to give us our $100,000 on week 10. Yeah. So that is one. How do we translate this into the charts? Because this is the calculation we have just done. We have to put this calculation into the charts. Understanding that, 10 minutes. Understanding that 50 pip stop loss is going to be so there is a pip calculator where we have to see all of those things. There's a pip calculator on every platform or any broker. There's a pip calculator to know how much is per pip of a movement. There is a pip calculator. I want to get it, please. Maybe I have to join with my phone to be able to bring that out. Just a moment, please. I want to be able to get it before I talk about it. AUD NZD, I want to use that as an example. Statistics. No, not statistics, details. AUD NZD details. Okay. I'm currently checking on my phone just to be able to tell you. I can't find that here. But we can just go ahead with that. Let's say we have this position. And of course, this is a buy position that we already have from here. It's clear it's a buy position. So let me just pull the trigger for the sake of time. Our time is up. I'm in. And if we are going 1:3, our stop loss says we should risk $34. Struggle to actually drag this thing. I remember the last time we were trying to drag it, stop loss. I remember the last time we were trying to drag it. It was stressing us, especially when the time is up like this, you know. Let me see if I can. If I can even get the second one to respond. This guy is not responding. Let me see. This chart is not even responding. That is the issue I have right now. Why this other one wants to play with me? Okay, you know what? Let me see if I can log in from my second device and maneuver it. Just a moment, please. Okay. let me see, 1.0975. 1.0975. So the stop loss is here and it is $13. So that stop loss is less than our risk. It means we can take less than that. We can take up to 38, 34. So this even means that this means our loss size is small because our stop loss should be around this zone here. This is a trade, this is a support, so our stop loss can be anywhere around here. Our stop loss can be anywhere around here, which is at 19. It means that we can still take more position because we are supposed to reach 34. So 19 divided by 34, or how do we do that? 34 divided by 19. Can still add more position. 34 divided by 19. 1 point, almost 2, right? So what is the lot size? 1.7. So go back again there. The lot size for this particular trade we just took right now, we check on that trade, we'll see it. We took a buy on 0.03 on a 2,000. Oh, what are we doing? We need an account of $100 to do this. Anyway, I'm just assuming that this is a $100 account and I want to take a trade on $100 that will give us 34% risk. That's what I'm trying to achieve right now. Forget about the analysis. We're not talking about the analysis. We're just talking about the risk management, how to set the risk management. Assuming we took a trade right now and we'll put the stop loss where the stop loss is supposed to be. We are supposed to see that we are risking 34. If we don't have $34 risk, we have to add more position until our risk is 34. Then also, as the risks will be there, let's say, let me close this position. The best thing is not even to close this position. The best thing is to log in from my phone. Just hold on. Hold on. I'm having issue with this device. Let me try to log in from another device to see. Just a moment. I'm logging in now. I'm logging in now. Just a moment. I'm logging in now. Let me stop sharing the screen. Make this device co-host. Our time is up, so I'm trying to round up. Share my screen. Start broadcast. Then you go to MT5. Then which account should I use? Let me get an account and see if I can have an account of $100. Tests, risk management. The lowest they can give me is $3,000. Okay. Opening. So I just created a demo account, text risk management. So of course, I talked about demo account the last time. You have to do every testing on a demo account. When you see that everything is right on a demo account, then you take it to a live account. Here I have a demo account, and I don't know what is drawing me to that AUDNZD. AUDNZD. I don't know what's drawing me to that assets, but then let me still stay there, go to the chart. I want to buy this asset, but I want to do it with $100. This $3,000 account balance is not good for our calculation, right? So what I will just do now to bring down this account balance to $100 is to open gold. If I go to gold right now, under 2 seconds, I'll be able to bring it down to $100. So I'm trying to bring down this account balance to $100. Let me change the risks to one lot so that I can do that very quickly. Ten minutes, please. 10 minutes. 10 minutes.
Just how many minutes? No. Maybe
10 minutes. 10 minutes, please.
You want to use your phone for a little bit. Wait, I want to call mom. Then I just to stop the crying.
Okay. 10 minutes, please. All right, let me use a higher lot size and see if they can accept that lot size. What about 2? Can accept 2. What about 0.5? I can take more positions. I'm trying to reduce the balance to $100. So once I jump into the position, they will take their spread and the balance will reduce. I want to do so until I get $100, then we can use it for our experiments. We need to always test our positions on a demo account before we execute the position on a live account. So this is why you need a demo account. Another reason why you need a demo account is part of risk management. You use your demo account to test your positions, to check if everything is in line, the stop loss, the take profit, the calculation. You know what you are looking for already. So when you go to the chart, you know what you want to see. You know the maximum stop loss you want to have. You know the maximum take profits you are expecting to see, or the minimum take profit you are expecting to see, as the case may be. So right now, I'm in the process of dropping down my demo account to $100. And once that is done, I'll be able to proceed with my calculation. I'm trying to burn down this capital from $3,000 demo to $100 demo. Once I achieve that, we can proceed with the other one, the setup, the settings for a 34% rather.
Again? You again?
Yeah, I'm almost done. Just a moment. You can see what I'm doing. It's not easy to crash an account too. When you don't want to crash the account will just be there crashing. But when you want to crash the account will refuse to crash. Let's see what will help me faster. You know what? Because of our time, I will continue this later. I will continue this process of crashing this account later. Let me just go ahead and take the risk. At least I've shown you the process of bringing down the account balance from $3,000 demo to $100. So you can have a $100 demo account to do your experiments. So let's say you have the account and you have this asset you want to buy, not this particular one. Let's say you want to buy AUD I don't know what's pulling me to the asset. We have not done any analysis per se that we should take this trade, but just peradventure, assuming we want to take this position, and we are using, we are going to risk 34% of $100, which is $34. So if we take a 0.5 and we buy, we tap on the trade, the SL is what matters. We drag the SL down. It's showing us 150. See where the SL is supposed to be. This is the support level here of this movement. This is support level. H4 support level is here. This is a previous support level here. So the stop loss always supposed to be under the previous support level. That's 2 steps backward. That's what we call it. The stop loss is supposed to be 2 steps backward. This is the first step, the first support where we are, the trading range. The trading range is from this place to this place. So the market is supposed to move from here to this first range, from here to the second range, till we get to our destination. So if we are putting stop loss, the ideal stop loss is 2 steps backward. This place is the main trading range where we have the OTE at this level. Then this place is the first step backward, the previous support level. Then it's supposed to be 2 steps backward. Step number 1, step number 2. Anywhere here is good for stop loss. This is our stop loss location. But the problem right now with this stop loss is that look at what it's saying, that our stop loss is 238. It means that our lot size is too much. So what do? We save the position first of all, then we go and reduce the lot size. We reduce the lot size. We are reducing the lot size down to, how do we reduce the lot size? You go to the trade. We are reducing the lot size down to very, very down. You click on this round icon. On the laptop is also similar thing. You see this is the position. We will go change the lot size from inside the position. Let's change it by 40. We change it by 40. Say close this position by 0.5 at this with a loss of this. No problem. Close. So we drop down the lot size to 0.1. So we'll go back to the chart. We'll touch that stop loss again. The risk now is 47. 47 is not what we are looking for. We want the stop loss to be 34. So we go down again to reduce the lot size. You see that round ball, the round ball with good? We click on it, MT5. We can reduce this 10. We can remove 8. No, not 8 is too much. We can remove half of it. No, half of it is too much. We are seeing 47 there, so we can remove 4. We can remove 0.4. 0.4. Because we have 10 there, 0.10. So we remove 0.4. So we still have 6 left. So we are down to 0.06. Let's see the stop loss. The stop loss, touch it. The stop loss is 28. So we want this trade to be 34. If the stop loss is 28 and it's not enough, we want to be 34. So this 0.6 is not good. So we'll close it. We want 0.7. 0.7. 0.07. Buy. Buy 0.7. 0.7 gives us stop loss of 27. It's still not okay. We need more than that. We can do 0.8. There are calculators where we can actually calculate stop loss and take profit. There are calculators for it, but I'm just taking you through the manual way because when every automation is gone, you are left with manual. You still need to know what to do. We are 0.8 right now, and here 40. This is 37, 34. Yeah, I think this is not bad. Our stop loss is good. Our stop loss is good. Our stop loss is good. So let's go. If our stop loss is good and is in the right place, our take profit will be 1:3. If we are risking $34, our profit is the best take profit is, and this cannot be the best. The best take profit will be giving us 102. 102. 102. That's around here. Save it. So you see that our potential profit makes sense. 1:3. If this trade, there's a bullish engulfing already, and there is a potential move going on right now. If this trade fulfills this move, if we look to the left-hand side, it can do that. The left-hand side is showing us that we have a potential resistance at this level. So can the trade get to where we are envisaging? Oh, yes, it can even get more than there. The trade can go more than that place. Sorry, this is okay. I mean, this guy. Our trade can go more than that place. Looking at the chart and looking at the trend, it can go more than that place. So we have this trade right now running to our destination. So the correct lot size to use to get that risk, to get that risk management at where we have it right now on H4. Our risk calculation, we remember we do it on H4, 2 step backward from H4. First step, second step, right? So we have our risk is here. You can see the space between our risk and our reward. We can calculate how many pips we have there. The pips really doesn't matter because it varies from one asset to the other. So it doesn't really matter. What matters there is the amount we are risking. It's a money game. So we are looking at the amount. Our stop loss is at a very good location in terms of second level support on H4. If it violates the first level, if it violates the first level, we still have this second level. If it violates this level, that's all. It means that it's going downward. But it's possible to violate this level and still find a rejection around this other block here and go upwards. So that is why we keep our stop loss after this level. If it violates this level, if price violates that level to the downside, it means that price no longer have a tendency of going upward. Therefore, price will start going downward massively. So we have to look for a sell position. So this is why our stop loss is at $34, 1.098. So if it doesn't violate this level, if it does whatever it's going to do, probably move up directly or move down before moving up, whichever one it does, and it picks off, if it breaks this first resistance here, there will be no further obstruction. It's a free way. It's a free driveway. If you go to D1, you will see it. It's a free driveway. See all this drop? We call it freeway. The trade has a freeway. From here, it was a massive drop. There was no rejection. So we call all this movement a freeway. This freeway is capable of allowing this price to move when we have our trade take off after breaking this first rejection, resistance level here. It's going to drive all the way up because no obstruction here. The next target will be anywhere from here. It's going to break all of this place easily. This is the first hurdle. If it crosses this hurdle, the next other hurdle will be a weekly hurdle. Let's go to weekly to see. The next other hurdle is also a freeway. You can see it's a freeway. There's no rejection there. Let me go there so you see. It's a freeway as well. To the left-hand side, you see it's a freeway. So it's capable of doing that. But this trade doesn't look like a weekly trade. That's the problem now. It takes 1, 2, 3, 4, 5 weeks to get that kind of trade done. So that means we have to look for a better position. That brings us to setups, trade setups, and which trade can deliver 1:3 within a week. So this trade obviously can deliver 1:3, but from the way I see it now on the weekly chart, I don't think it can deliver it in 1 week. I think it's going to take more number of time depending on what is happening in the market. So that will deal with setups and analysis in another class. The purpose of this class is to understand the settings, how to set the risk management, where you put the stop loss, where you put the take profit, how you calculate the stop loss and the take profit, using a case study of $100 to $100,000. Talking about $100,000 from $100, the challenge is starting January. I'm part of the challenge. Blessing Aguasha is leading that challenge. Blessing Aguasha has done a lot in terms of risk management for several assets and several trades that we have been managing. This is one of his trade management, and he has shown himself worthy in terms of character and learning over years, more than 15 years in this market. So I think he's the best person. He's one of the best persons we can say should lead this challenge from $100 to $100,000. One single trade per day is using mostly minor pairs, as you can see on my screen. And he's able to find those entries. And of course, the losses are few when it comes to a number of losses. So all of you listening, watching from YouTube, watching from the Zoom call, you are welcome to this challenge with Blessing Aguasha. And all you need to do is to register with the recommended broker for this challenge. If you click the link on the YouTube, it will take you to the WhatsApp group. If you reach out to me as well, I can also give you the link to the recommended broker. Once you set up your account and you fund a minimum of $100, it's usually good to fund more than $100 in case there's an issue with the account, so you can top up back again and continue the journey. So the moment you are in the, you have funded your account with $100, starting from second week of January, hopefully the market is balanced, or even maybe within the first week, we can get a good setup. All the setup will be called by the trader, the master trader, Blessing Aguasha himself. He's going to call the setup. Your job is just to enter the trade. Learn how to enter, learn how to exit, learn how to set up, put the lot size. Usually the calculation for the lot size are done by the trader and by the trade managers in the group. So your job is just to take the analysis they have given you, see the position, see the lot size, and know where we are going, and just implement on your account. So you are not going to be working alone. You're not going to be doing everything by yourself. You are just going to be following the people that know what they are doing. But this class has helped you to see what is involved in setting up your risk. I know it's not going to be easy for somebody seeing this class for the first time to understand everything. I know that for sure. But then just see how the process goes like, and continuously attend the class, watch again for the second time, attend more classes, ask questions, and before you know it, you will gain mastery and clarity of how it works. Somebody's asking a question already. They will say, well done. Was still enjoying my Christmas for God's class. I came late. No problem. You can always go back and watch the video. The topic is how to set risk management on MT5 or MT4, as the case may be. One of the things we did was, number one, to first of all define what is your stop loss, what is your take profit in a trade. How much will you lose if the trade goes bad? How much will you make if the trade goes well? If you determine that, then you do the calculation. If this trade goes well, what will I do next? How much risk will I take? If this trade goes bad, what will I do next? How much risks will I take? You will do all that calculation on paper, first of all. It's like the architect that wants to build a house. He doesn't go and start buying building material. He first of all start by writing a plan, drawing the design, then writing all the calculation, canceling, start again until you get a final proof paperwork that is fully, complete, that this thing takes you from point A to point Z. Then you can now start clearing the bush, digging the foundation, employing people, executing what is written on paper. So that is one of the ways to set up risk management. Then when you get to the MT5, you need a demo account. There are calculators, there are automations, how you can calculate and know the exact lot size to use, the exact stop loss to use. But I don't want to take us through automations when you don't even know what is happening yet. So you need to go through the manual, get a demo account, and open the position with the size. Let's say you have a $100 account, you are using it for a case study. The best way to understand something is to experiment it. So you have $100, you want to experiment how to set risk management on a $100 live account using our challenge as our $100 challenge with Blessing Agwasha as a yardstick for understanding this thing we are talking about. The best way to understand is by practicing. So if you set up your $100, the way to calculate all of that is using a demo account. So you go to a demo account, reduce your demo account down to $100 and start using it for the same purpose. Set up, take the setup, check the stop loss, change the loss size, take it up, take it down until you get the exact loss size that is equivalent to that stop loss. A good stop loss should be around 50 pips or less. If your stop loss is more than 50 pips, it's a bad stop loss. If your stop loss is around 50 pips, it allows the space, the breathing room for that trade. If your stop loss is around 50 pips or 100 pips, it allows breathing room. If your stop loss is more than 50 pips, if it's going to 100 pips, it will take a longer time for your take profit to be achieved. Remember, your take profit is 1:3. So we say if the stop loss is around 50 pips, then the take profit is around 150 pips. 150 pips, if you check any market within the minus, you see 150 pips is achievable within a week. One entire week is what you can see from the, what is it called? What you can see from the period separator. This is a period separator. This one and this one, they are period separator. The lowest move in that market is this yellow line. The highest price in that market is this positive line. So if you bring cursor to check, I want to calculate how many pip movement this market had in one direction for previous week. Just using this market as an example. This is 1.0998. 1.0998. Then the highest was 1.1083. So this is approximately 91 pips movement. That asset in last week, it moved 91 pips. So that will inform your decision which kind of asset you could choose or you could use. Mostly, this asset will not deliver what we are looking for. But if we go to an asset like USDC HF and you check how much movement do we have in that asset in a week. Let's say a previous week like this one from here, 0.8772, 8772, and the highest point for that week was this point, let's say 8941. 8941. $169 pips. And what we need there is 150 pips. That's 1:3. So this kind of asset can deliver 150 pips in a week. So there are some calculations or not is it calculation now? Analysis. When we come to analysis, we can analyze how many pips does this asset deliver in a week? We can check it. We can analyze it in the last 1 week, in the last 2 weeks, in the last 3 weeks. Then from there, we can say, okay, if these pips can deliver this kind of movement in a week, then in this particular week, where are we? Can we join this pip and get so amount movement within this week? The answer is yes. Then we go ahead and take it. We explore it. So it's based on analysis. So, but for this class, we are staying only at risk management. So in our next class, our subsequent classes, we are going to talk about analysis. We're going to talk about analysis. So I'm going to stop here for today. If there are no questions, if there are questions, I will take the question inside the WhatsApp community channel. Then in the next class, I would like us to go to talk about the bull run, how to locate cryptos that are yet to be launched. We had that amazing topic discussed by Mr. Wells in our last bootcamp. There are cryptocurrencies that are going to be launched in Binance, in Bybit, in Mexi, wherever they are going to launch them in a centralized exchange. Before they get to centralized exchange, they will first of all be launched in decentralized exchange. So how do you see those coins? How do you know that they're going to launch? What is that coin that is going to be launched in the next 1 hour? What is that coin that has just been launched 5 minutes ago? How do you take advantage of them? How do you know which one to buy, which one not to buy? So you are able to catch this thing before they get to the centralized exchange. So when they get to the centralized exchange, that's the time where you are supposed to be selling, because so many people, they usually buy the coin when the coin launch at a centralized exchange. When they see the coin on Binance, that's where they begin to buy the coin. Why you have to be faster than them? You have to buy the coin before the coin gets to the centralized exchange. Of course, you have to also check to know the market capitalization, the people trading it, the social media engagement, the interest of the project. Will this project get centralized exchange? Because once the project enters a centralized exchange, from a DEX to a SEC, from a decentralized exchange to a centralized exchange, the project usually gets a lot of attraction and a lot of money comes in, and then those people who bought early will begin to take profit when there is any small move in the centralized exchange. So we are going to be looking into that in our next class. That will really inform our decision on the bull run and get us better prepared for what is coming. This, where we stop today, is something you need to go and practice. Your homework is to set up a demo account. When you set up a demo account, begin to practice. Put a risk of 34%. Put a risk of 34% on $100 and set the position, put the stop loss at $34. Then they take profit at $150. Take a screenshot and send in the WhatsApp group chat. Take, for instance, you have this asset. Let's say we go H4. Yeah, we're in H4. We go 0.08. We jump into a buy position. Let's say we go into, I was supposed to use a demo, right? Let's say we have a position here. I did not analyze, but let's just say we have a position there. We buy the position and we put our stop loss. This is the first support, the second support. Second support is supposed to be around here. So that means our lot size is too big, because the stop loss for 34 will be here. Is it a good stop loss? I think it's not a very good stop loss. So I think the lot size is supposed to be something smaller. Let's say 0.6. Then we hit it hard. Remove that 0.8. It's not the right lot size. 0.06 is the right lot size, because 0.06 can give us a stop loss of 34 here. This place is still not a good stop loss. So we reduce the lot size to 0.5, 0.05, and knock it. We take out this 0.06. We don't need it. We put our stop loss at 34, 36, 34. I still don't like the position of our stop loss. 34 is still inside our trading range if we are taking this position. So I think we have to reduce the lot size again to 0.04 and take the trade again. So take out this one, we don't need it. So reduce that trade to what we have right now. Our stop loss is 34. Here, at this place, our stop loss is at a good location. Second support below. It's far away from the entry. It gives us enough space. Then our take profit is going to be $102. $102. So this is what we are willing to risk, $34, and it is at a very good place. And what we are willing to gain there is 102. Let me check if the movement can be done. Yeah, that is the next resistance level. It's possible to get there. It's possible to get there. But then the movement started earlier before. So we would have entered quite earlier and it would have been better. So what I need from you on H4 is to show me your stop loss and your take profits. Just do a demo account and show me this. When you show me this, touch like this and take a screenshot. This is 38, it's not good. Can change it to 34. What I need from you as homework is to do like this. Do like this. Send me this. Send me something like this into this group. This is what I need from all of you. This is what I need from all of you. So if you can do this, that is okay. If you have any question, please drop the question in the channel and then we'll take it up from there. See you tomorrow. See you tomorrow.